All right, this is the fun part. This is where we get to forecast the future. Okay, so let's do this. And just so you know, when you do this, it's often more of an art than a science. Okay, it's more of an art than a science. You need to accept the fact that your estimates will be off, but you just need to look at historical trends and do the best you can in terms of projecting what the future might look like. Okay, so E means expected. What we're going to do is we're only going to forecast quarterly numbers for this year. Okay. And then what we'll do is going forward for 2017, 18, 19, 20, we're going to do those on an annual basis. It's just much easier that way. Okay. So let's kick it off by forecasting on a quarterly basis. Okay. So remember the conventions. The convention is that blue means hard coded. Okay. And then green is from another tab. Okay. So let's kick it off by forecasting the revenue line items for we'll kick it off with Talent Solutions. Okay. So this here is blue, and I'm going to show you how easy this is, right? And again, it's more of an art than a science, and you will never be 100% right. Nobody is. Nobody can predict the future when it comes to so many independent variables, even the company itself. Okay, so let's go over here, and I'm going to forecast these quarters here. I've already done this, and so what I'll show you is how I did it. So you can see that the year-over-year customer numbers has been decreasing steadily over time from 35 to 34, 32, 30, right? That's the average for the year. And so it's come down by 2% there, about 2% there. So let's just continue that trend, okay? So we'll make it 28 here, right? That's hard coded. So if I delete it, it kind of messes up the numbers. There you go. Everything is fed off of that, okay? And then what we'll do is we'll make it 2% less here, right? We're keeping up with the pattern. 2% less here. And 2% less there, right? Make sense? Good. And so for the year, we're at 24.8%. And going forward for future years, we'll just deduct 2% or so, or 1%. We'll assume that the slowing of growth will slow down to about 20% year over year growth here, which is how it works. And remember, I showed you the couple of graphs at the beginning there. Growth is slowing. And we're not assuming they're going to make any acquisitions here. It's too hard to incorporate that stuff into our models. Okay, let's look at revenue per customer. Okay, so revenue per customer is all over the place. It is impossible to model. And so you see here, revenue per customer was down 1% year over year, right? Then it was up 0.5% here. Then it was up 1. Then it was up 11. And so for the year, it averaged 2.9% up. Right. And so for us, what we're going to do is, looks like there's some seasonality here, right? Some seasonality. It picks up. It's at, I guess, a Q4 seasonal high. Remember, a lot of businesses see revenue pick up just temporarily in Q4, especially in the retail sector, given holiday shopping. Okay, so I'll do the same similar pattern here. I'll make it 0.5. I'll normalize it here. I don't know why it was negative that one time there. I'll assume it was kind of a one-off. And then 11% there. And so for the year, I'm at 2.9%. And then we'll go down there just very slowly, so that, growth slows like it usually does, right? Okay, good. And then we've got lynda.com here, and forecasting Lynda is kind of tough. I don't really know what to do here. Growth is slowing a lot there. I only have a couple data points, so I'll just assume it slows down more to there. And for the year, growth is going to continue the slow year over year. But I'm assuming that growth is actually going to be pretty good for Lynda for a while, because a big company bought a smaller company. And so the big company has bigger distribution channels. And a good example would be to use Coca-Cola. So when Coke introduced or invested whatever in Dasani, Coke had incredible distribution channels around the world. So Coke can distribute Dasani water everywhere. Right. And so if Coke were to buy Red Bull, hypothetically speaking, Coca-Cola has more relationships around the world. And so Red Bull revenues would spike for a while because Coke has bigger distribution channels. Okay, I digress. All right, so looks like we're done there. Good, we're done. And all this stuff, right, it's pretty easy. It's just a couple little line items here. It's percent. It feeds into the rest of the model. Okay, great, done. So we're done with that revenue line item, right? This revenue line item is really simple. It's just hard coded, right? So this was all just kind of extra information given, right? So all this information here is going to be given in the press release or the 10Qs. We're not going to forecast this stuff, right? So let's look at pattern recognition. Remember, modeling is basically everything that's percent of sales or pattern recognition. And it looks like marketing revenue growth, which is the second line item of 3, it looks like it's slowing, right? And so we're following similar patterns here. We're slowing it down. And then eventually on an annual basis, and again, it's not perfect, never is. See how revenue growth slows there? And we're done with that. Okay, good. And then premium, I think we got to drill down in this one if I remember correctly. That's right. There we go. Whoops. Sorry about that. All right, so okay. So what we're doing now is premium. We've made a number of assumptions, and it's basically the Sales Navigator product year-over-year growth is slowing a lot. See here, I went from 40 down to 29. So we're just assuming it's going to continue to slow. And then eventually it'll slow by a couple percent per year and whatnot. Okay, good. And the same thing with Sales Navigator, the ARPU, or average revenue per month, per user per month, that will slow as well, right? Over time, slowly over time. Okay. And then down here, the registered number of users will also slow. So there's 414 million registered users as of the end of last quarter, right? And that growth was 19%, slowing a little bit over time, see? And so I'm going to slow it down here as well. It's very gradually over time. And eventually growth will only be 15% year over year there. And then it's interesting because only 0.25% or 0.24% of customers pay. And so I didn't know what the right number was, 0.26 or 0.24. So I kept it that amount there and just had it slowing a little bit over time. And the average revenue per subscriber has been $30 forever. And so we'll include that there. And that's, kind of on a monthly basis, like I showed you my personal subscription where there was no credit card. And that's it. That's all you do, okay, for revenue. And revenue, we spend the most time on because everything is generally speaking a percent of revenue. Okay, great. So there we go. We've got these revenue line items here all the way out. Okay, good. All right, so let's go to the income statement and let's model the income statement. And the rest of the model is actually pretty straightforward. And we're going to get rid of this little crystal ball or whatever that thing is called. I don't even know what that's called. Okay, so I threw that over there. It's just good visualization. And then we'll do the same thing here as well. And everything here is just going to be a percent of revenue, right? So here we are, E, we're forecasting the future. And again, your numbers will be a little bit off, and don't worry about it. It is what it is, right? So here, cost of goods sold as a percent of sales was that amount, and it went up, a little bit, whatever, and then back down. And we kind of play around with that seasonality here as well. And then eventually we assume that there's going to be leverage in the model, right? So expenses as a percent of revenue will go down. And we do the same thing with sales and marketing, product development, G&A, depreciation. Again, everything is just a percent of revenue. And so last year for sales and marketing, we see the percents come down slowly. We'll assume that that continues over time. And on an annual basis, you see here how it gradually trends lower. Same with G&A, that's general administrative. Same with product development, which is also called R&D. And then depreciation, it's just a percent of revenue, right? Same thing with stock-based compensation. It's always just a percent of revenue. And then eventually we come down to our provision for taxes, and we don't know what the tax rate is going to be longer term. So we just assume it'll gradually increase. Most companies pay low 30s percentage, whatever it is, taxes. Depends on the country you're in or the state or municipality. So I don't want to spend too much time forecasting taxes. You generally just call up the company or look in the 10Q or 10K to see what taxes are and then forecast them that way. And a lot of times on the earnings calls, they'll have taxes as well, right? They'll talk about that at length, right? Okay, so there we go. We've got our earnings each year going forward. You can see that year-over-year growth actually is going to accelerate. And the reason we have it accelerating, remember when I showed you the charts early on of expenses and revenue in our model? Well, revenue growth is slowing a lot, right? See, the growth is slowing. See? And so we're assuming that they're going to be cutting expenses just to make investors happy, because they'll be losing a lot of investors that love the high growth rate of the company, but they'll be gaining a lot of investors that love the increasing profitability metrics as well. And that's quite common for a lot of different companies as well. And as you can see, the adjusted EBITDA, which is operating profit margins, are increasing nicely over time. Okay, so we're done with the income statement. Again, remember that the green numbers are numbers that are brought forward from a previous tab. Blue numbers are hard-coded. And the balance sheet's not as hard as you think it might be. A lot of people have problems forecasting the balance sheet. It's not that difficult because similar to the income statement, everything is really just a percentage of revenue. And the only reason that we forecast the balance sheet and the cash flow statement is so that we can do a certain valuation metric, which we'll cover next class, called DCF, or discounted cash flow analysis. Okay, the other methodologies we're going to use for valuation, like price earnings and price to revenue, and there's many others, don't really use forecasts of the balance sheets. Okay, great. So these are historical numbers. You see they're hard-coded in blue. Annuals, you don't need to be here because it's just the last data, right? And remember, the balance sheet's just a snapshot in time. Okay, so now we're going to forecast. And again, the green numbers mean it's from another tab, right? And so this green number here is going to come from the cash flow statement. Okay, cash. I'll get there in a minute. You'll see. Receivables is going to come from the income statement, right? It's just 17.5% times sales. How do I get that, Chris? Well, over here, you can see that receivables as a percentage of sales changes by the quarter. So I basically just used a similar pattern there. It's not perfect, but I think you get the idea. And then you'll go down through all your assets, all your liabilities, and a lot of it is just a percentage of revenue or is pulled from, somewhere else. So in this case, 1.8% for other assets times revenue, right? How else are you going to forecast that? It's too hard. Same thing with accounts payable. It's percentage of sales, right? So that is just 4.5% times percentage of sales. I looked at historical patterns here and tried to model it to the best of my capabilities. Same thing here with debt and retained earnings, which is just pulled from another statement. And retained earnings, remember, is just the increase or decrease in a previous year's or quarter's net income, right? So the earnings or net income are retained. And then I add a lot of comments here so I know exactly where I'm getting the stuff from, right? So here, short-term investments, I'm assuming it builds 100 million annually as cash flow builds. And that's just from looking at historical patterns, whatnot. And again, it's not perfect, but it's close enough. And then you've got deferred commissions, which I'm telling you is just a percentage of revenue. Same thing here. I'm just reminding myself what all this stuff is from. And okay, so I'm not a big fan of forecasting balance sheets or cash flow statements because I'm not a big fan of DCF, which is down here, but I'm going to show you how to do it anyway. And the reason I'm not a big fan of it is because there's so many independent variables in DCF. So if I told you x plus 1 equals 3, we all know that x is 2. If I told you x plus y plus q plus w plus 1 is 3, what is x? We have no idea because there's just too many independent variables, and that's what DCF is. But I want to kind of create a menu for everybody here to follow from, so I'm including it. Okay, let's move on to cash flow and let's forecast the future here. And you think this might be complicated, but this one's actually the easiest one. And it's the easiest one because it's actually already calculated for you, right? Remember, all the greens are from previous tabs, right? Blues, we don't have any blues to enter, right? I just don't know. I don't know how to add a forecast for provision for doubtful accounts, just being honest, and sales returns, right? It's kind of all over the place here. And so are these things, excess tax benefits. I have no idea. And the same with this. So they kind of average each other out. So I'm just going to make them 0. And they're not going to move the needle that much anyway. Okay, there you go. And so all these line items are just pulled from previous statements, the balance sheet or the income statement. And let's double click on them and just see where they came from, right? So let's go here, you double click it. Depreciation is right off the income statement. We know that, right? Same thing with stock-based compensation, right? And that is basically net income from the income statement. That's GAAP, right? Remember GAAP? And we're doing all this stuff in the cash flow statement to figure out what real cash flow is, because the income statement is a lie. That's why you have a cash flow statement. It'll tell you what the real cash is. And here you just pull this off your balance sheet. Was a change in accounts receivable, deferred commission, prepaid expenses, all that other stuff. You can read that right there. It comes right off of the balance sheet. And then again, we've got free cash flow here. Okay. So free cash flow is basically operating cash flow minus CapEx. Remember that. Free cash flow is operating cash flow minus CapEx. And all this stuff here is calculated for us so that we can forecast our DCF, right? So the free cash flows will feed into there, which I'll cover in the next section. And so that's a recap on how to forecast your financial statements, right? Basically, everything is a percent of revenue pretty much. And then you just look for pattern recognition to decide how to forecast it, okay? And every model is different, but a couple things are similar. One of them is that most items are percentage of revenue, and you always look for patterns in the data. One data point doesn't make a trend, but a couple always does.